And now for something completely different.
It's a Rick World.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is that best day of the week. Well, almost the best day of the week. It's technically the second best day of the week. Because it's hump day.
It's close enough.
Yeah, exactly. We're getting there. And also we're getting there to the fact that Christmas next week. So, we've just trying to give you, this has been your friendly neighborhood Spider-Man updates that...
Fair warning.
Yeah. And actually, a couple of announcements out yesterday from FedEx, UPS, others. Today is basically the last day you have. If you want to make sure your shipments get to where they're going to be on time, you better get them out. You better get to clicking on Amazon.
Get your mouse to clicking.
Get your mouse to clicking, because otherwise it ain't going to get there on time. And I've tried for years. I've talked about this before. Is that really we should get a lot smarter.
Yeah.
And and so we should give people. We should just tell people on Christmas what they're going to get, and then we buy it after Christmas when it all goes on sale.
Like an IOU.
Well, yeah, you give them a back order slip. Our good friend over at Mattress Mac over at Gallery Furniture, back order slip. Yeah, there you go.
Yep.
And look, you could save money. Everybody still gets, and actually people get better presents right after Christmas because all the good stuff goes on sale. So
give them a picture.
Yeah, I've tried that with I've asked my family about that for years. Never go for it.
No, ain't gonna happen.
Never go for it. So, are you familiar with reindeer food?
Yes.
Okay, you're familiar with reindeer food.
Yes.
Okay, so we were having a conversation. Last night we were having dinner with our kids, and we were all kind of reminiscing about Christmases when they were young and the things they remembered about about being young and about this. And one of the things we did every year is that we'd go out in front of our house and we would sprinkle reindeer food across our yard. Of course, it's basically oatmeal and glitter for the most part, right? So we'd sprinkle glitter across the yard and stuff like this. And
makes wonderful scat.
It does make wonderful scat. It really does, and it looks pretty at the same time. But of course, it pretty much dissolves overnight, because of the dew, etc. And so. We're talking last night, and we're talking about reindeer food, and just for the briefest of second, my son's standing there going, because what happened? Did y'all have to go out and clean up the reindeer food? And I go, well, where do you think it went? And just for the briefest of moments, you can see, well, the reindeer. Wait, there are no reindeer. It was just for that briefest of moments that, that
moment of clarity.
Exactly. So, yeah, reindeer food's an awesome thing. Anyway, a couple of things this morning to get into, speaking of reindeer food that disappears overnight. Stimulus is still in the works, and we may actually see potentially some movement this morning. Mitch McConnell, of course, and the upper leaders, Nancy Pelosi, Chuck Schumer, et cetera, they're all trying to get together, work through this stimulus package, trying to get it out to market. This is giving the market some hope. Markets are up a little bit today. Markets rallied a bit yesterday, had a nice day yesterday after basically we've had about a week's worth of kind of weakness in the markets, and we've talked about the money flow indicators been trailing off here for the last week or so. We're still in this consolidation range, but the important thing is that yesterday we bounced right off the 20-day moving average and the previous breakout high. So we now have a confirmation of that breakout to new highs, and with that open yesterday, we did add exposure to the markets yesterday for that rally. So we actually picked up a little bit of just index exposure right towards the lows after the open in the morning. And have added that to portfolios. Now, doesn't mean we're out of the woods just yet. We've still got some room to consolidate here. And again, as long as the money flow signal's intact and your MACD sell signal's intact, that does potentially give you some downside pressure on prices in the short term. But again, we are moving into the seasonally strong period of the year. Now, about the only years that you have, not good Decembers are in years that you've got bear markets, et cetera. And with exceptions, you've got things where the Fed is doing basically some, not so great things like 2018, like trying to hike rates. Those lead to declines in December. But you typically get this push in the markets that comes in the last 2 weeks of December, first week of January. So again, you do want to be aware of that. Now, the problem, though, here is, and this is what we've talked about for the last couple of weeks, the speculation in this market is at extremes. Call option speculation, which is one of the most speculative ways to trade into the financial markets, is at record highs. People are just taking on an immense amount of risk to chase markets. And back in 1999, I was there in 99. Brent was there in 99, too. But we had all these day trading shops opening up all around the country. People would open up an office building. You would go there and you day trade stocks. And this was the thing. And again, this is when E-Trade was first getting started and online trading was first kind of really coming to fruition, and people taking on margin debt. But the general attitude was the same. It was a no lose, can't lose market. No matter what happens, the markets just don't go down. And there was excuse after excuse after excuse why that was the case. And of course, people were chasing stocks that had no valuation, no earnings, no income growth. In a lot of cases, didn't have operating business models. But that's what the sentiment was back in 1999. It's interesting because you're now seeing exactly the same thing, the same type of attitude today. We have, these SPACs, which are special purpose acquisition companies that are public companies. People back in a company into it. It goes public. People are running these things up to a large degree, paying way in excess of valuations of what these companies would ever actually be able to earn. But it's this no-lose market, right? And if I can take on that leverage and take on options to do it, how can I go wrong? The problem is that ultimately something always goes wrong. This is the thing about markets. Markets are great about sucking in the majority of investors at near the peaks of markets, and they do a very good job of that. And when you start getting stock tips from, your grocery store clerk, your cab driver, Uber driver, Lyft driver, or whatever it is, you have to really start to think about just kind of where we are in the cycle. And when you see people quitting their job, and this is happening, people quitting their jobs to go trade stocks. Why work as a construction laborer if I can just day trade stocks all day? It's so easy. Why wouldn't I do it? The problem is that markets are not always that easy. And when they do get into the situation they are now, typically that's when returns become much more challenging in the future. And here's an interesting dichotomy of this. This morning, there was an interesting chart out this morning talking about the recovery of the markets and that almost 100% of fund managers expect earnings to improve in 2021. Okay, so now that's not rocket science, right? We just went through a recession. We just had a big correction in earnings that, by the way, that nobody expected in 2019 either. You just had a big correction in earnings for 2020. So now 100% of fund managers expect earnings to improve. No kidding. That same survey of fund managers found out they also expect the sunrise tomorrow. So the point here is that now they say, well, earnings can catch up with valuations. That's true, but only if stock prices either decline or are flat next year. If prices continue to rise, and there's currently an expectation of a 10% to 15% increase in asset prices next year, then earnings can't catch up to lower the overvaluation of the market. So again, this is just basic math, but this is where we are within the cycle. Exuberance and greed have far outpaced logic and how markets actually work. So we're going to talk a little bit more about that this morning. Danny Ratliff is joining me as well. Exuberance is way out on the curve here, but Santa Claus did come to town yesterday, so that's the good thing here, right? So we should get some lift here for the next couple of weeks, but use that opportunity wisely. Be right back after the break. I'm your host, Lance Roberts.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me, talking a little bit about markets, money, financials, the kind of the whole nine yards here about kind of what's going on. And as I was talking about just at the open here, I just ran a series of charts this morning on our Twitter account just to really discuss a little bit about, this excess speculation and exuberance in the markets. And this is always a very interesting dynamic, right? I've been doing this for almost 30 years and, crash of 87, 99, 2008, been here, done this, seen this repeatedly. And it's always very interesting that when you start, hearing people talk about, I've discovered this, I developed this whole new trading system that, I'm doing now that, I'm trading my accounts and, I've got a system, right? And this is the same thing that people talk about when they go to Vegas to play blackjack, right? They've got a system to win at blackjack. And the thing is that it will work as long as the market is working with you. And that's where we are in the markets right now. This, as I said earlier, this is what seems to be a can't lose market. And there's certainly plenty of reasons to think that, right? And the general excuse is, well, look, the markets can't go down because the Fed won't let it go down. That's a very dangerous statement because the Fed doesn't control the market. They can supply liquidity through loans to bank excess reserves, but that's all they can do. And they don't buy equities at this point. Now, if that changes, it's a different dynamic. But that's not the case as it is right now. And look, Japan has been buying equities. And here's the interesting thing about Japan. Japan has a balance sheet that is larger than the Federal Reserve's on a relative basis. Japan's about 1/3 the size of the U.S. economy. Their balance sheet is actually larger than what we have on a relative basis. And they've been buying, they own 80% of the bond market, and they own 80% of the ETF market. The Nikkei is 31% lower than it was 30 years ago. So, you've got to be careful about exactly what you're wishing for here because, what seems to be easy in the short term tends to turn out to be problematic longer term. And again, so we ran the series of charts this morning just looking at some of these things, right? Call options, which are a way to make leveraged bets on the stock market is at extremes. In fact, the last time we had such an extreme increase in call option activity at one time was in 1999. But when you look at the chart now, the use of call options has risen so much that blip in 1999, you can barely see it anymore, right? It's just we've gotten to an extreme point of taking on an extreme amount of risk and leverage and confidence. I mean, when you start hearing people talk that have no financial experience, basically have never traded before, et cetera, talking about developing their own trading systems and trading models. And, when I hear teenagers talking about, their trading, on Robinhood, et cetera, and some of the stuff that they're buying, look, it's all working, right? And it's easy to be a genius in this type of market. It's also one of the most dangerous. So again, this is not the time to be taking on more risk. This is a time to be selling risk to others. And this is an important concept to think about.
Well, that's interesting. You said selling risk to others, and that's assuming that there's always somebody on the other side
Right.
that will buy it at the price that you want.
Correct.
And that's the key right here is that we're seeing so much, markets have moved so quickly. I mean, I think we forget very easily that how things looked prior to November. Mm-hmm. I mean, it looked pretty bleak for a while. Mm-hmm. And, we've been in the doldrums for quite a bit, and then all of a sudden we see the market take off. Now, we've been expecting a bit of a pullback. We've had a little bit of one, but not probably what we were expecting. With, mutual fund distributions, things of that nature. But it looks like we're going to be sailing through the end of the year with stimulus, with more good news on virus.
But at some point, you're going to have to reevaluate. Say, okay, what does 2021 actually hold? Mm-hmm. And then how do your strategy? So everybody has a strategy to get in, and it's great when everything is going up. But what do you do to get out? That I think it becomes the issue.
Right. Well, and the problem is it's going to be, what we've done now, too, in particular, is because of passive indexing, right? We're all buying ETFs, which, again, that's great because I can buy an ETF and the ETF goes up and it's fantastic. But that ETF has to buy all the underlying stocks. So the problem becomes, and we saw this in March, the dark side of passive investing is when investors start to sell, it liquidates entire baskets of stocks all at once. So it's very indiscriminate. Everything gets hit at the same time. Everything goes down. And this is why you had such a very sharp decline in March of this year, right? And it's pretty amazing that investors have already forgotten what happened in March. In March we had people screaming off the off building ledges trying to figure out how to get out of the market, and now they can't wait to get back in. And they've forgotten about what just happened a few months ago. And this is going to become a much more regular occurrence, unfortunately, in the future because of what we're doing to the markets, because of the leverage, the speculation. You've got margin debt now back at all-time highs. You've got call option speculation at the extremes. So you're going to have these dislocations are going to become more frequent. They're going to be bigger and more frequent, but overall, this is going to become part of the volatility mix you've got to deal with. But this is going to be something that has big implications down the road. But at the moment, nobody believes that because it simply seems as there is no risk to the market. And this is something called moral hazard. And we actually wrote an article about this not too long ago, talking about what is moral hazard. Moral hazard is when people take on risk, believing they have insurance. So think about it this way. If you go to Vegas and you sit down at Vegas at a blackjack table, right? And the dealer said, hey, you know what we're going to do? We've got this new policy here. We're going to reimburse you your first $1,000 of losses, right? So if you'll spend up to $1,000, gambling with us, we'll reimburse your first $1,000. Now, if you know you're going to get your money back, how much risk are you going to take on playing hands? You're going to take a lot more risk, right? That's moral hazard because I believe that I'm going to get reimbursed for my losses, so I'll take on more risk. If I'm playing, Texas Hold'em, right? I go all in every hand because every hand I go in, if I win, I get the whole pot, and if I lose, I get my money back, right? That's a good deal. That's what the Federal Reserve has done to the markets. The Federal Reserve has given what people think they have as insurance that the Federal Reserve won't let the markets go down, so markets can only go up. And that's a very dangerous assumption because the Fed doesn't control the market. What they can do is they can try to influence by, using verbal communication and by using liquidity, but they actually don't control markets. If something dislocates in the markets, it won't matter what the Fed does eventually. Prices will go down. And whatever happens that triggers an avalanche of selling because of the passive indexing syndrome will lead to a very sharp dislocation in the markets, as you saw in March, right? People forget this very quickly. In March, the Federal Reserve was already doing QE. The Federal Reserve had started doing QE September of 2019 because we had an illiquidity issue going on within the markets and we had an inverted yield curve. The Federal Reserve was in the process of doing QE already, and the market still dislocated in March. That's where we are in the cycle today, and that will happen again. So it's all fun and games, as my mom says, until somebody gets an eye put out. But we're in the end part of the year. The markets are very optimistic, very exuberant. The question you have to ask yourself is ultimately how much more good news can be priced in. We've already priced in the vaccine. We've already priced in an economic recovery. We've already priced in an earnings recovery. That's all priced in now into the markets, valuations, market cap to GDP, et cetera, all at record highs. That all says that you'll have lower rates of return in the future. So you have to ask yourself the question, how much risk am I taking? And can I sell that risk to somebody else? And that's the real issue. And that's going to be the trick to managing money over the course of the next, really, couple of years.
Well, how many people do you think are actually having that type of thought process right now?
Nobody.
Nobody is.
Why?
Well, then that's exactly right. So the unfortunate thing is that most people do believe they have that insurance underneath everything that we're doing. And, the Fed has proven that they have been there to some extent.
Yep.
And we know that without the Fed, without the stimulus, we'd be having a much different story. And, we've talked about this. I mean, who would have thought that if we said, hey, look, we're going to lose a third of GDP, we're going to have a big market decline this year, but don't worry, markets will be higher. You just said you're nuts. There's no way. But we look back and, I mean, we always want to rationalize, especially things that are irrational like the market today. And what's the only thing we can really go back to is probably stimulus is one. So it's understandable why people would think this insurance policy will be here. The problem is the more and more of it you get, the less effective it will be over time.
Right. And we've done that study, actually. When we did QE1 back in 2009, we were actually getting about $1 worth of return off 50 cents of QE, right?
Yeah.
So for every 50 cents QE, we're getting about $1 worth of return from the market. Today, it's taking $2.50 of QE to get $1 worth of return. So so what you're talking about is the efficiency of QE, and you have a diminishing rate of return on every $1 worth of QE you do. And so the question ultimately becomes is that the Federal Reserve can only operate from the function, the standpoint of the debt that they monetize. So the government has to go further into debt and to deficit in order to generate the debt that the Fed can monetize to provide liquidity. It's a nasty circle. What that leads to is slower rates of economic growth. So, while we're standing here talking about how investors are speculating in the market, et cetera, it's also important to remember that 10% of the population owns 90% of the stock market. So for a vast majority of Americans, and we're going to talk about this after the break, even people that make $100,000 a year fear they can't retire. Why? Because they're not participating in financial markets. They're just struggling to make ends meet. And this is the reality of what's happening within the economy. If you take a look at survey after survey after survey, the average American can't come up with $500 to meet an emergency. It's unlikely that they're also participating in chasing financial markets. So, when we're talking about financial markets and bubbles and these type of things, and look, this is clearly a financial bubble that we're in again. Okay, all financial bubbles end eventually, but they can last a whole lot longer than you think they can. But this is why it's important to think about the idea of selling risk. This is going to be my new meme for the week: selling risk. But anyway, we'll come back. We'll talk about what it is. Why are Americans struggling to really make ends meet and to retire? We'll talk about that coming up on the break with Danny Ratliff, CFP. Don't go away.
Listen anyplace, anytime at realinvestmentadvice.com.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get Fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get Fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
You're listening to The Real Investment Show.
Gotta make a move to a town that's right for me.
And welcome back to the show this morning. It's 6:33. So just talking a little bit about, the exuberance in the markets. Everybody's making money. It's all fun and games. It's pretty much like a casino, right? The great thing about the reason, if you ever go to Vegas, by the way, Vegas is not a happenstance area, right? I mean, things just don't happen inside of a Vegas casino for just random reasons, right? There's a reason why there's lots of bright lights and bells and sirens on top of jackpot machines and all that stuff. It's all very specifically designed to tap into your psychological behavior and to drive you. If you see other people winning and doing things, you hear the bells going off, you see the lights flashing, that makes you want to go and spend money, right? Because you want to get in onto it too. Social media is designed specifically to tap into that dopamine effect, just like Vegas, in order to get you to continue to like and post and scroll, because every time you like something, every time, I tell my kids this all the time, is why are you making all your friends money rather than you're just sitting around looking at stuff? Because every time you like something, every time you scroll past it, those ads that you just scroll past, you don't have to actually look at the ad. You just have to scroll past the ad, and advertisers pay money for that. It's all designed to tap into that dopamine effect. The stock market works exactly the same way. When markets are going up and all the lights are green, you want to get into it, you want to chase it, you want to do these things, and you don't think about the risk, right? And the risk is how much money you lose when something goes wrong. That's what risk is, right? So we were just talking about that before the break. But it's interesting because when you look at the population of the country, you would think that with the stock market going up, everybody's making money, right? Everybody's got to be in this. Everybody's got to be doing it. But it's actually not the case. If you take a look at 401k plans, one of the beliefs is that, and I hear this a lot, it's like, well, everybody contributes to a 401k plan now. No. Only about 50% of employees in the country have access to a 401k. And believe it or not, only about 50% of those people, about 25% of the population, actually contribute to a plan. And very few of those, roughly half, actually maximize their contribution to a 401k plan every year. So you're talking about 1/8 of the population that actually maximize the benefit of their 401k plan. And we know this because we look at 401k plan, Fidelity and Schwab and others put out the value of their 401k plans every year. And they'll say, there's a record number of 401k millionaires. And then when you actually look at the number of accounts that are the $1 million 401k plans, guess what? It's 1% of the total number of the 401k plans, exactly what you would expect from the population, right? The average balance is about $50,000, $55,000, about 1 year's worth of salary for most Americans. So, this is a problem. People making $100,000 and more, right, are concerned about retirement. They have less than, $500 in the bank. And while we talk about how great the market's doing, the reality is and this is when we talk about the wealth gap as well. One thing that Danny works on all the time with individuals is looking at, what they're spending, what the future value of that money is going to be, and what's going to cost to live. And with interest rates at, less than 1%, the challenge of meeting retirement income is going to be problematic.
This is a common conversation that we're having. So first and foremost, we see that 401k, those numbers up close and personal. We help a lot of businesses with their 401ks. And especially this time of year, we're going through making sure that all the funds are still good funds to invest in, that people are participating. We're getting, information out that's required by law. And so we're spending a lot of time. And I'm seeing those numbers that you're mentioning right now, Lance, that the participation rate is between that 50 and 60% range. And this is the people who have a lot of access to this. They have lots of information about it. It's not something where it's necessarily an afterthought. And so we're seeing that quite a bit. But the other conversation is how do you diversify assets? And you mentioned, talking about the wealth gap and how it used to be where, we've talked about this frequently. We used to be able to go get 4 or 5% out of fixed income, no problem, with very little risk. Those days are gone. And so, it's a common conversation we have of what does even our fixed income portfolio look like here in the future, just in general, and where do we go with how do you invest? And I think that's going to be a problem where a lot of these plans are going to be stuck because you just don't have the options to get a little bit more creative to build some fixed income. And I think that you're going to see a lot of people taking on additional risk that they don't realize.
Well, honestly, that's what you're seeing now, though, right? We talk about, the attitude of people wanting to chase markets, et cetera. Markets are going up. Why would I own fixed income? Mm-hmm. I want more return, right? I want more, I can get a higher rate of return from stocks than I can from bonds. True, for the moment. But this is also part of that moral hazard from the Federal Reserve is that they've driven rates to such a low rate, less than 1%. That it's forcing people into the stock market to create some form of return. I can't get a return on cash. We just looked at a bond yesterday from Ford Motor Company, right? Now, they make automobiles.
Isn't Tesla going to buy them?
They should.
I'm kidding.
They should. But no, Ford Motor Credit, right? Been around 100 and some odd years, et cetera. It's a junk rated company. Ford Motor Company is junk rated. They are double B bond. Now, you would expect for a double B bond that I should get about a 4% yield roughly 4 to 5%, to buy junk. And that's really kind of ridiculous to be buying junk for a 4 or 5% yield. It should be around 9 or 10, ultimately. That's what the normal credit risk rate for a junk bond is. The bond was yielding 2.75%. So this is where we are in the markets. We've driven rates that even now taking on credit risk is no longer advantageous. So why would I buy a 2.75% junk bond when I can buy a stock that'll yield, 2.75 and potentially in a day, right? If I happen to catch it on a good day, a stock can be up 4 or 5% these days. That's because that we have a real lack of liquidity in the market that's causing these massive price movements. And we see Disney is a good example. Disney reported an announcement on Monday that they expect to have 86 million subscribers by 2025, I think, on Disney Plus, right? Sounds fantastic. People ran the stock up 15%. Now, this is Disney, who has no park revenue at this point, is financially, really stressed because of what's going on within the economy and is very consumer driven. But people ran it up because of this idea is that they're going to have this big explosion growth. So Disney's now going to be the next Netflix. Now, what they all forgot about this was that they forgot to extract out of all those numbers the cost of production of all the movies they've got to produce to meet that demand that they're going to have from 86 million subscribers. So the profitability has now been more than priced into Disney for the next 5 years. But the point, though, about that is that you don't see in a major market cap company like Disney a 15% move in a day unless you have a lack of liquidity. And what that means is that there are basically no sellers, and you've got buyers willing to buy the stock and they're willing to pay any price for it. So sellers go, yep, run that price up and I'll finally reach a point where I have to sell it or where I will sell it. So, this is the problem. There's a saying that I've heard this a tremendous amount now over the last few days. There's a record level of cash on the sidelines. There is no cash on the sidelines.
You hear that every year.
Every year. And it's a great bullish argument, but there's no cash on the sidelines. Why? Because for every buyer, there has to be a seller. So whenever somebody buys something in the market, somebody had to sell their shares. So the net transaction is always zero. So if there's a pile of cash magically sitting on one side of the market, when it comes into the market, the other side of the transaction will sell to meet that buying demand. The net liquidity is zero. The problem today is there is no liquidity because there are no sellers. Nobody's willing to sell until the price reaches a point that you can drag sellers into the market. Now, here's the trick. It works in reverse. When prices begin to fall, the buyers will evaporate and the sellers will be rushing in to sell. And that's why you see declines like you saw in March, where it's a 35% decline in a month or a 10% decline in a month, like we saw in both September and October. It's because buyers will buy much lower and sellers will sell much higher. And that's what's causing a liquidity issue within the markets. And that's ultimately going to be a problem down the road.
Well, but let's get back to the root of the problem is that we still have so many people that aren't participating in markets.
Yep.
We have
I'm sorry,
people,
I deviated.
No, but it all kind of flows together. I mean, you have people that don't have the access to even go out and buy Disney on their own. Now you have Robinhood, you have other things that make it more accessible, but that also that probably magnifies the problem in some ways because now we can do things that we typically wouldn't, and we can do them at a much quicker pace. And so that emotion gets involved, which is why I believe, you talk about the flashy lights, all the things in Vegas. Well, it's the same thing for consumers. And that's why you have half the people making over 100,000 they're afraid they can't retire. And, you look at different articles, and I mean, we pulled one up here, and it says, well, don't worry, save $300 more, and you're going to have $300,000 in 27 years. It's like, wait a second, at 8%, granted, every single year.
Right.
And so that's...
But why want to get 8% every year? I mean, the market just goes up.
Yeah, well, of course. I mean, have you lost money? I mean, if you don't sell, you never lose. I mean,
exactly.
That's the old moniker, right? But the other thing is everybody says, well, invest aggressively. And so you're seeing a big push towards that. And, I think that's a little bit misleading in so many ways because we don't understand, especially once you're near retirement or you're taking distributions, that's a game changer because investing aggressively is part of the problem, I think, for many people who maybe they didn't save enough. They didn't save, and now they're doing that. But what ends up happening from there can be really detrimental.
Well, that's because you have to go to the second part of the article, which we'll talk about when we come back from the break, which is you also have to alter your retirement plans. What? We'll be right back after the break. I'm your host, Lance Roberts. Get by the website, realinvestmentadvice.com. We've got a couple of new articles out on our website now. Michael Leibowitz has his latest post up, as well as we have a very interesting article about what investors need to know about investing. That's on the website now, at the website, realinvestmentadvice.com. Send your questions, comments, emails. Let us know what we can do for you. Be right back.
You're listening to The Real Investment Show.
Get 2020 off on the right foot with our next Candid Coffee Financial Bootcamp. Get Fiscal with Richard Rosso and Danny Ratliff and learn the landmines to avoid, tax advantages we see, and money tips you need to know. Our next Candid Coffee can better prepare you for the changes we'll see in the new year with a new administration. Get Fiscal with Ratliff and Rosso. Register for the 2021 Financial Bootcamp edition of Candid Coffee Saturday, January 16th at RIAadvisors.com. RIAadvisors.com.
The Real Investment Show.
Welcome back to the show this morning. So just talking a little bit before the break about retirement and, people with $100,000 fear they can't retire. And that's certainly a reasonable expectation, right? Because if you're making $100,000 a year, you got to do some quick math here. I know it's early in the morning. Nobody said math was required on the show. But just bear with me for a moment. Back in 1980, you could get a 14% yield on 10-year treasuries. 12 to 14, depending. Which means that if you put $1 million into treasuries in 1980, you could generate $120,000 a year to live on. Now, here's the difference. We talk about this. The average cost of living in 1980 was about $25,000 a year. So if I'm getting a 14% rate of return, that's easy math. Today, the average cost of living to raise a family of 4 in the U.S. is about $60,000. And look, it's early in the morning. We're going to round the interest rate up to 1% from 0.91, so I can do easy math. But, on $1 million, you're making $10,000 a year, right? Technically at 0.91, you're making about $910 a year on $1 million, right? I mean, how do you support a family of 4 of $60,000 a year on $10,000 a year in income from bonds? This is the problem, right? And this is what's forcing individuals more and more into stocks because they can't generate a return off of fixed income. Even if you went and bought a bunch of junk bonds, right? Like we were talking about a moment ago, Ford Credit, right? 2.75. So let's go buy $1 million worth of Ford Motor at 2.75. Okay, great. You've now increased your income, to $27,500 a year. You're still short $60,000. So, this is part of the problem with a lot of these articles, which they say, well, if you just invest $300 a month into this and you invest aggressively and you get 8% a year every single year without fail, you never have a down year whatsoever, you're going to have $1 million in the bank. Great. You still can't retire on $100,000 a year. This is the problem that we're running into. And this is caused by the distortion of the markets over the course of the last few years because of the Federal Reserve has caused this problem. Believe it or not, back in 2008, the 10-year Treasury yield was over 4%, right? Not 1%. So this is where we are. So the advice is always great, right? Invest more, invest aggressively, which has not worked out for investors ever in history. And then also the other side of this coin, which they fail to tell you about, is, you also have to cut your standard of living. So instead of living on $100,000 a year, you need to learn to live on 40.
Well, but here's
This
something
becomes much more challenging.
Yeah, but here's something I think that many people fail to forget. So a lot of people we visit with, they say, well, I make $100,000 a year. I need $100,000 in retirement. We say, okay, so great. Let's actually start backing out on what you actually need in retirement. Because they want to net out saying, well, I need 100. Well, that's what you're grossing. Let's take away the insurance. Let's take away, we start talking about the expense aspect of it. And what we find is that many people are living on much, much less, especially if you're contributing to the HSA, to the 401ks, you're contributing in other areas to IRAs, and you're saving money. Well, now you're not going to be saving money in retirement any longer. You've been an accumulator. Now we're becoming a distributor. And so now we can back out and say, well, maybe it isn't that 100,000. So I think psychologically the impact is great, because we've never actually thought through the process. I feel like a lot of times we get there and we're like, okay, well, here we go. We need X amount. Whoa. And so this is why we talk about the 4-letter word, the budget, and then, what people are doing all along the way. And I think this is where, we find that making those adjustments is not as bad as we suspected. And what we need isn't necessarily always as high. But we don't do as good of a job on the front part of this to ensure that when we get to that place that, quantitatively we're ready, right? Financially do the plan, but then qualitative, the aspect of what you've done psychologically to get there. That's the tough part. I mean, that's what we talk about in our Right Lane workshop, how people fall in the black hole because it's such a difficult time trying to get from, having the purpose to being the accumulator to actually distributing assets. But this is the thing, like you mentioned, people are going to have to make changes, especially if we're in a lower for longer scenario that we think we may be in. Now, we've seen markets which, for the last part of this last month or so have been great. Trade sideways here for a couple of weeks. Looks like we have that Santa Claus rally coming. And then, we're going to have to take a look at this again and say, whoa, where are things really going? Now, do we just see that markets and stimulus and everything is going to continue to be great? I mean, shoot, the stimulus, they've been working on this for how long now?
Well, but look, here's two things about stimulus. One, or real quick too, while you are talking about the fact that when you first enter retirement, you're going to live on less. The other side of that coin is, unfortunately, and we've talked about this before, is that we haven't taken care of ourselves health-wise. So, which means that we're going to be spending a lot more money than we expect in retirement on healthcare in a lot of cases.
So Lance, you're going to like this. We call that the retirement smile. Okay, because initially when you retire, you spend a little bit more because you're checking things off the bucket list, right? So it goes higher. Then all of a sudden it starts to decrease as people say, well, I'm not spending as much because I'm not traveling like I used to, or we're not doing some of those same things. And we check those things off the bucket list, and then it comes down. And then you're right. So it starts going back up because the healthcare expenses.
Exactly. And just, but that's just part of it. But this is why financial planning's, so very important, and to really kind of plan this stuff out. But it is going to be challenging. I mean, there's no doubt. And as we get into next year in particular, we're going to find other challenges as we go forward, and expectations. Again, you've got overly exuberant expectations, and when everything is overly exuberant, that's typically when you get disappointment. And markets work off disappointment and optimism. So when things are very optimistic, prices go up. When you start disappointing that optimism, things go down. If you take a look at like the Citigroup, Euphoria Index, it's at record highs. I mean, people are just about as exuberant as they can be about the markets. And why shouldn't you be? Again, next couple of weeks will likely be fairly good for the markets. And talking about, but stimulus is a good point here. There's a lot of expectation that stimulus is going to have this big impact on the economy. And I'm going to tell you right now, it's not. And then the reason is simply because of math. Back in March, we had no economic activity, right? Everything shut down. And we hit the economy with unemployment benefits and a $1,200 check. So everybody had this cash, and they went out and they spent it in the economy. So all of a sudden, we got this big rebound, 33% rebound in economic activity in the third quarter because of all this money that we hit the market with. Okay, so let's assume that $600 a week in additional benefits, which was more money than people were making to begin with, and the $1,200 check hit an economy that was growing at zero, just simple purposes. So now the economy is growing at 1%. Okay, so we've now doubled the rate of economic growth because of that money. Now we're about to come in with a stimulus package that has no $1,200 checks to household and is only $300 for 4 months. So it's half as much stimulus, but you've already doubled the rate of economic growth. So the impact of that stimulus on the market is going to have a lot less impact on economic growth going forward because you've already had the recovery and you're providing less money. So when we look at economic growth, when we looked at the 33% jump in economic activity, that was based on quarter-over-quarter comparisons. When we look at year-over-year growth, it was only about 4%, right? Still a good number. But we compare economic growth on a year-over-year basis. So now you're going to do a comparison over stronger economic data with less money. So this is called the second derivative effect, which is the change of the rate of change. And that change of the rate of change will be slower. And that also suggests that we're going to have a less impact on corporate revenue, corporate profitability, and corporate earnings. Those could come in weaker than expected because revenue growth is already weak. And even with less money, you'll still have lower rates of revenue growth going forward. So it's something that's the risk. Yes, we may get a stimulus package, but it's only for 4 months, and it potentially won't have as much impact to the economy.
Well, I agree, but I think that it's just going to be the sentiment that it provides. It's going to provide that backdrop,
absolutely.
the safety net. And look, I think it's very well needed because there's still a lot of people out of work. We have millions of people on unemployment. Small businesses, they've gotten a shaft here. I mean, did you know there's a record level? I know you know this. There's a record level of bonds that have been issued this year. So these big companies that are publicly traded that have easy access to capital, they've been able to take advantage of this and take advantage of the low interest rates. Whereas the little guy, I mean, how many businesses do you see that can do that? They can't even refinance a mortgage.
Well, this is what I said earlier is that, the problem with the stimulus program, the PPP program, et cetera, is that it all went to the wrong places.
Yeah.
And if we're going to do stimulus, if we're going to do more debt and more deficits, which has a negative economic impact over time because we have to service the debt, it needed to be a much more targeted approach to actually just helping small businesses. You don't need to give people unemployment insurance directly. Help the small businesses, and they'll hire people.
Yeah.
Right. And so you have to think about the trickle down effect and the way this works in the economy. But we've wasted billions upon billions of dollars, fraudulent applications, fraudulent unemployment benefits, fraudulent PPP loans, companies, big public companies that have access to public markets to get access to capital, got PPP loans, should have never been allowed.
Yeah, no, that's absolutely right. But, going back to your point, so we lose, what do we lose? 34% of GDP, give or take. And then the next quarter, we gain that back. And everybody says, wow, we're back to where we were. No. You're a third of back to where you were.
Exactly.
We're not near to where we were. And that's the issue. But the markets responded favorably because they said, look, things are getting better. And I think that could still be the case for a bit until we look and say, whoa, this isn't really what we think it is.
Exactly. That's the risk for 2021. As I said, optimism is great until optimism is in excess of what reality can deliver. And it's the disappointment of optimism that becomes problematic for markets. And that's the point you want to pay attention to as we go into 2021, which is why we want to talk about selling risk once we get into next year. Have a great day. It's Wednesday. It's hump day. Second best day of the week. So there we go. Danny Ratliff, thanks so much for joining us this morning. Get by the website, realinvestmentadvice.com. Send us your questions, comments, and emails, and we'll see you tomorrow on the next edition of The Real Investment Show right here. I'm your host, Lance Roberts. Have a great day.
Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.